Are we headed for a bear market? It's sort of the question that's on a lot of people's minds right now with all of the changes going on in the economy, the trading with our trading partners, etc. But let me try to put it a little bit in perspective for you. There's not an easy answer for this, but I think this will help things make a little bit more sense. The economy is a bit like a runner in a marathon, but instead of a runner that paces itself, it acts more like a runner who starts off at a sprint for the first several miles and then has to slow down and walk for the next mile or two. And then the runner repeats himself in so many different ways, sometimes jogging, sometimes sprinting, sometimes walking. You can think of the market as sort of driven by two broad categories of drivers: fundamental economic realities over the long run, and that's typically about 12 to 18 months, and psychological greed and fear in the shorter term, which is typically 1 to 12 months or so. So when we look at the S&P 500 over history, depending on the timeline we're observing, we often see its return coming around to something like 9% or 10% on average. But remember that this is the average. And what is an average? Well, the average of negative 10% and 30% is 10%. But that 10% average tells us almost nothing about whether we should expect the negative 10% or the 30%, or something far different for any given data point. The average that's often quoted is not the return investors see every year. It's usually not even close. That's what I mean by averages are not normal. That's because the market acts like an untrained runner in a marathon. At any given moment, we don't know whether the runner is going to sprint, casually jog, come to a complete stop, or even retrace his steps backwards. This guy is not the brightest marathon runner. But interestingly, because he's so consistent over the longer term, we can come to estimate his total marathon time that stands with strong likelihood of being close to accurate. Here's another comparison that comes from physics. At the smallest level, quantum particles appear to exhibit random motion. We don't know how to predict how a particle will move for any given trial because we do not know what the cause is for them to move left versus right, for example. But over time, with enough trials, that particle moves with enough consistency that we can accurately predict the bigger picture of what is 99.9999% likely to happen in the bigger world that we see from day to day. It's like flipping a coin millions of times. If we only flip the coin 10 times, there's a much higher chance that we might get heads all 10 times than if we were to flip the coin a million times. The more times we flip the coin, the more likely we are to get a 50-50 result with a negligible margin of error. That's a lot how the market moves. Now, the market does not appear to be completely random from day to day, but it is almost completely random. This is called random walk. So how can we accurately predict where markets are headed? Are we headed into a bear market? Is this just a head fake and it turns out to be just a market correction? This is the million-dollar question that everyone is trying to predict right now, from the seasoned professional to the man or woman who just wants to make sure they have enough when it comes time to retire. What the market is not is this. The market is not a 50-50 random chance when it comes to 5, 10, 15, 20, 30 years or more. Markets tend to grow in about 75% of years. Not only that, but when they experience downside, even long bear markets, on average, the upside years are dramatically longer in duration and stronger in upside return. And there are far more pullbacks and corrections than actual bear markets. Pullbacks of negative 5% to negative 10% often happen multiple times in a year. 2 to 3 is a good estimate. Corrections of negative 10% to negative 20% don't happen every year, but usually they happen at least once within a 2-year time span. Here's the trick that gets most investors, though. The best positive days often happen in very close proximity to the worst negative days. What that means is the market acts in such a way that makes it almost impossible to effectively time it and be better off in the long run for doing so. Notice I said almost impossible. That's why only about 10% of fund managers are able to actually add value over the long run to simply holding a passive benchmark ETF. And that's why most hedge funds, even, are not able to materially add meaningful long term returns for investors. Hedge funds often act as a way of diversifying risk and lessening volatility as part of a larger total investment picture, but adding significantly to returns by making money in up and down markets consistently, exceedingly rare. So, back to the original question, are we headed into a bear market in the days ahead? Possibly. The chances of a bear market are a bit higher this year than they've been in the past, but more likely than a continued bull market? Not quite yet. The chances of a bear market currently developing still remain too low for it to be prudent for long-term investors to consider taking a serious defensive move. Why? Well, remember what I said previously. The best upward moves often happen in very close proximity to the worst days. If you lock in the losses from the big down moves like we've been experiencing over the past several weeks and the markets recover, it's very likely that you could miss out on, let's say, 10+% of upside before you have the confidence to jump back in and resume the bull market trend. Now, I've had clients who previously said they preferred to risk missing out on that 10% plus upside if it meant eliminating the risk of riding through 20% or more of downside. Well, that sounds nice in theory, but here's the tough reality. First of all, using this arbitrary example of 10%, missing 10% upside, this time doesn't just mean that we're missing 10%. It means that we're missing 10% growth compounded over your entire life or time horizon. So if you have a time horizon of 30 years, and let's say a portfolio of $100,000, and you go defensive and just pull everything to cash, which is almost never the right thing to do for a long-term investor, but let's say that you do. Then let's say that the recent downside doesn't develop into a bear market, but recovers pretty quickly, as they usually do in market corrections. And you decide to get back in after the markets have gone up 10%. Well, you have $10,000 less than you otherwise would have if you just stayed put. But over 30 years, if we assume an average growth rate of 8% annually, you've actually given up about $100,000 of opportunity cost. That's a very expensive way to avoid the fear of a bear market in the short term. And if it happens more than once, even if this theoretical investor is correct from time to time, in the long run, they still end up with far less than they would have by simply sticking to a long-term strategy. This happens in the vast, vast majority of market timing cases, even among professionals. Now, this is a little different for short or intermediate term investors, those who will likely need the money for spending within 1 to 10 years would be considered short or intermediate term. Market timing can actually make more sense for investors with shorter time horizons, but it should usually be done in combination with proper asset allocation, which is the long-term risk management side of the equation. Asset allocation means the percentage an investor keeps in stocks versus bonds versus alternatives and cash. Now, we could get really into the details by also recognizing that there are some investors who love the risk, whom we call risk seeking. And they're ready and willing to accept the higher chance of loss for the chance of faster gains. And then there are risk avoiders who are willing to give up gain potential for the chance of being able to meet their goals right on time and not needing to push those goals out any further into the future if things go the other way. But bringing this around to where we are presently in markets, the likelihood of a coming bear market appears elevated, but still not likely enough yet to make a bet to the downside a statistically likely success. The way I personally determine my opinion on this is by examining a number of fundamental economic data points, as well as technical indicators that help understand investor psychology on the shorter term basis. I look at a number of things, but here are some of the main ones. Daily moving averages, the 50 and 200 day. Monthly RSI. Speed of a market drop, slow and rolling versus fast and sharp. The Shiller price to earnings ratio. Purchasing managers index. Leading economic indicators. Media sentiment. The US presidential year. Exactly how I use many of these is discussed in my available online courses and the upcoming membership, but these are listed here to show that predicting a bear market's development is not a matter of one or two red flags, but weighted statistical probabilities that overlap others. Now, things can change over the next month or two, where the likelihood of a developing bear market becomes prominent enough that those with lower risk appetite or need, or a shorter term time horizon, might have reason to reduce risk exposure through a variety of methods. But at this point, the market movement appears to exhibit more correction like characteristics than a bear market. It appears more driven by uncertainty than by actual deteriorating fundamentals that would lead to a long or deep recession. Now, one disclaimer I want to make also is that even though I've been a financial advisor in the past, anything I say on this podcast is not investment advice. Investment advice can only properly be given on a one-on-one basis, because regardless of what is happening in markets, what's right for one investor to do may be completely different or even opposite than what another investor might be right to do. And that's because of the nature of many differences. That's time horizon, risk tolerance, goals, flexibility of those goals, income, assets, debt, and many other factors. So again, I never give investment advice generally or broadly, and that should never be inferred on this podcast. If you want personal investment advice, I expect to be working one-on-one with a handful of individuals in the near future, or you can find a financial advisor that you trust that can help walk you through an investment plan customized for you personally. Finally, I'll say a word about stagflation. You may have heard that word mentioned in the news in recent weeks. If we enter a period of stagflation, then that could indeed mean a bear market precedes and accompanies that sort of economic downturn. Stagflation is a stretch of time during which unemployment rises, the economy slows down, and all the while, inflation runs too high. This has been speculated as a possibility lately because of the slew of tariffs which have been proposed and many already implemented by the US on trading partners. High tariffs happening at a time when inflation is still running above the long-term average target of 2% annually is sparking some fears about higher prices that aren't the result of a greater economic activity. If prices are going higher because demand for those products is going higher, then that's one thing. But if prices are just going higher because now it costs more to make or deliver certain goods, then in the short term, some portion of consumers will look for alternatives to go to, or they'll go into debt to keep up their standard lifestyle. That can lead to stagflation. I'll dive deeper on that subject of stagflation in the next episode. Suffice it to say now that I think stagflation still remains a low probability for the near future, and that lowers the probability of a bear market in the near future. Keep in mind, though, that in 2022, a bear market happened in anticipation of a recession that also never happened. So enough psychological expectation can move markets even when fundamental reality doesn't turn out in the same negative fashion. In the end, there's no simple answer to whether current market turmoil represents signs of an impending bear market. The evidence that I watch suggests likelihood is higher than normal, but still not high enough to make a downside bet statistically probable. The best long-term investors focus mainly on asset allocation and determined to ride through the vast majority of ups and downs that include bear markets from time to time. Investors like this tend to dramatically outperform market timers over long periods of time. The best short and intermediate term investors also focus on asset allocation, but have a stronger potential benefit and lower opportunity cost to attempt to time the market by using defensive strategies that match their personal need and desire for risk avoidance. So with all the political and economic change going on at the moment, the key is not to fret and worry about markets. Regardless of what markets do, the economy is still likely to continue growing over this year, and that's all markets need to do moderately well. The market needed to take a rest from its growth over the past 2 years, and that's exactly what it's doing right now. It could continue to be volatile throughout this first half of the year, but turning into something like a year or longer of downside, in my opinion, right now, that remains a very low probability. Be sure to subscribe to the channel and even visit me over at thewealthexpedition.com if you enjoy staying up with the markets and learning investing in bite-sized portions, which you can really use in a combined way to dramatically transform your life in a relatively short period of time. I look forward to hearing your story and walking with you along this exciting journey.